Life insurance is not about putting a value on one's life. After all, life is priceless. Instead, a life insurance policy's objective is to provide adequate financial resources. That's the key phrase. Adequate financial resources to one's dependents in case you were to meet an untimely death. Now, there are different kinds of life insurance policies, but in this video, I'll be focusing on term insurance plans and I'll try to answer the two most important questions. One, how to calculate the amount of term insurance cover one needs. And secondly, what are the steps involved when choosing the ideal term insurance plan? Now, very quickly, a term insurance plan's biggest USP is its simplicity. The policyholder pays a fixed premium every month or every year, and if he or she dies within the policy period, either naturally or by accident, then the nominee receives the sum assured. The most popular and the most marketed sum assured is 1 crore, and the fixed premium I referred to varies from person to person depending on the applicant's age, the smoking habit, and the tenure of the plan. Of course, there are some other things to factor like income, occupation type, the medical history, medical tests, etc. But when compared to every other kind of life insurance policies out there, the term insurance plan is a relatively simple and straightforward one. It's also very affordable, and annual premiums can be as low as 0.2% of the sum assured. These plans also offer tax benefits under Section 80C, which goes up to 1.5 lakhs, and also under Section 1010D, which basically says any death benefits paid out are fully exempt from taxes. A fourth benefit is on account of the sum assured, and the term plans offer a much higher coverage as compared to traditional or ULIP plans. And finally, term insurance premiums are locked for the entire duration of the plan. Now, some people get surprised by this last statement. So just to say it aloud, term insurance policies are long-term contracts often running into 20, 30, 40, even 50 years. And unlike a health insurance policy where premiums are calculated per the incidence of hospitalization, a term insurance plan converts the rising mortality chart into equal premiums over the entire life of the policy, giving us a fixed premium to be paid across the policy's tenure. For example, I bought my first term insurance policy, and I have two policies. So I bought my first one at the age of 30. It was a 2 crore policy, and I paid an annual premium of about 25,000 rupees, and I continue to pay the same 25,000 rupees at age 43, and hopefully when the policy expires in the next 17 years, I'll be paying the same 25,000 rupees, if you know what I mean. So simplicity, affordability, tax benefits, a high sum assured, and a premium lock-in, in my opinion, makes the term insurance plan an essential product to have in everyone's personal finance portfolio. In fact, enrolling into a term insurance plan as soon as possible also has a mathematical basis to it. For instance, had I not purchased my policy at the age of 30 and had I opted for it now, then the insurer would have charged me an annual premium of a little over 45,000 rupees. So figure this, at 25,000 rupees a year for a 30-year policy, I would have paid 7.5 lakhs and I would have been covered for 30 years. But by delaying my policy purchase decision, I would have forked out a number even higher than 7.5 lakhs for just 17 years of coverage. So if you haven't bought a term insurance policy yet, then this is some serious food for thought. And if you still have any questions on term insurance for which you aren't able to find answers on the internet, then write to me on hello@beginnersbuck.com. I worked in the insurance industry for over a decade, and although I'm a bit out of practice over these last 2 years, I'm sure I can figure out some answers for you. Alright, let's start with popular question number 1, that is how to calculate your ideal amount of term insurance cover. Now, the way I want you to think of this problem is exactly how your money needs to be spread throughout your lifetime. So in terms of cash flows, you are likely to be earning an income from now until the age of 60. And within those working years, you will have household expenses to take care of, liabilities that need to be paid off, money you would need to accumulate for some of your bigger goals like a child's higher studies or starting one's own business, and you also need to provide for your post-retirement years. Which means in case of your untimely demise, we need the insurance money to take care of your dependents across all these 4 scenarios. So step number 1 is to factor in your dependents' monthly expenses, and as an example, let's say this comes to 60,000 rupees a month or 7.2 lakhs a year. Now on this 7.2 lakhs, I generally recommend a multiplier of 15 times, which gives us our first block of 1.08 crores, and that will take care of the family's future household expenses, at least on a thumb rule basis. In fact, I deliberately chose a multiplier of 15 because if you have young children, then it will take a good 15 years for them to become independent and become earning members of the family. Also, there is inflation that is likely to grow at 6 to 8%, and this multiplier also assumes that your spouse might have to restart working and that the 1.08 crores would be responsibly managed via a fixed deposit or a balanced mutual fund. Step 2 is where one factors in the liabilities, and let's assume there is an existing home loan with an outstanding of 80 lakhs. So 1.08 crores plus 80 lakhs takes this life insurance coverage to 1.88 crores. Step 3 requires us to deduct any liquid assets you have. So a liquid asset is something that your family can access within a week of your demise. This includes things like your savings bank account, fixed deposits which can be broken, stocks which can be sold, mutual funds that can be redeemed, etc. Let's assume there are 20 lakhs in these liquid assets, which means our life insurance coverage requirements comes down to 1.68 crores. Step 4 is where you plug in some of your future life goals. For example, a child's education is an important one, and let's say you need 60 lakhs for this goal 14 years from now. Now, if we use the rule of 70, which I explained in the thumb rules video, then a coverage of 15 lakhs in present day money should get you there. Similarly, you'll have a few more such important goals, and let's say there are about 40 lakhs worth of life goals, which takes up our coverage to 2.08 crores. And finally, there is step 5 where one needs to prepare a retirement corpus for one's spouse. Again, we can use a thumb rule, the rule of 72, to get a better hang of this number. So assuming a standard annual return of 8% on one's investment, 1 becomes 2 in 9 years. And if your spouse has, say, 27 years to go before his or her retirement, then we're looking at a multiple of 8x. Which means if your calculation says that your spouse would need about 4 crores to manage the retirement years 27 years from now, then you need to factor in a coverage of 50 lakhs today. So this pushes up our life insurance coverage calculation to 2.58 crores. Now I'm sure there would be a lot of questions in your head on the calculations that I just did, which is good because it means you are thinking. We also need to respect the fact that estimating term insurance coverage is not an exact science, and there are a few logical assumptions that one needs to make around age, marital status, dependents, goals, etc. Further, and as a good practice, I'll also request you to be a little conservative in your estimates and to keep your spouse and at least one close relative in the loop when you're making these plans. So try this process out. I did it when I was 30 years old. And I did it again a few years later, which prompted me to buy my second term insurance policy. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips, and stories that I continually post in the community section. Alright, now let's move to the all-important question number 2 and understand the 6 steps one needs to take when choosing a term insurance policy. The first step is something we just discussed, and it starts with determining the life insurance coverage amount. And to quickly recap, the idea here is to be approximately right about what your monthly expenses, your liabilities, your assets, major goals, and what your spouse retirement needs will look like. Believe me, it's a lot easier than it looks, and I'll request everyone to spend just a couple of hours on this and work out a proper coverage number rather than the life insurance company giving you a standard 1 crore, which may or may not be sufficient for you. Step number 2 is for you to determine the tenure of your life insurance plan. And it's a very delicate question because you don't want the policy to lapse before your financial obligations are over. And at the same time, the tenure should not be too long because it means you're paying a higher premium on account of the higher tenure. Now, mathematically, the ideal way of arriving at the tenure is by estimating in which year will your liquid net worth, that is your investment portfolio minus your liabilities, will be more than your term life insurance cover. On a more practical basis, you have two options here. One, you can do something which I did, that is, I have one policy that goes up to 60 years of age and I have a second policy which covers me until 70 years of age. The logic here is that until the age of 60, I will be carrying most of my financial obligations, which means I should keep a high cover for myself. And when I cross the age of 60, I would have not only less obligations, but I'll also have enough financial resources to provide for my family, which means I can make do with a lesser amount of cover. That's one way of doing it. And the second option is more to do with a recent product offering that is popularly called the zero cost term insurance plan. So zero cost is more of a marketer's phrase, but technically these plans are very similar to regular term plans in terms of their product construct and pricing, with just one difference. That is, they offer a choice to the policyholder to surrender the term insurance policy and receive back all of the premium net of GST. So it's an option that the policyholder can utilize if they want, and in my suggestion, look at it only in two cases. That is, A, if you really need the money, or B, if you are done with all your financial obligations. The third step when choosing a term insurance plan is to target the highest peace of mind per rupee of premium paid. Now, what do I mean by this? You see, when I bought my first term insurance plan in the year 2010, it was a 2 crore cover which came to a premium of 25,000 rupees per year. So my mental calculation went as follows. 25,000 rupees multiplied by 30 years, which was the policy term, came to 7.5 lakh rupees, whose payment was spread over 30 years. So 7.5 lakhs divided by 2 crores comes to a little under 4%. Which means I had bought peace of mind for the next 30 years that my dependents will be taken care of for a mere 4% of the coverage. On a trade-off basis, if I die in the next 30 years, my family gets 100 rupees, and if I don't die, I would have spent 4 rupees. Now in 2010, there weren't many insurance companies that were offering term plans, but now there are over a dozen life insurers to choose from. And yes, while premium and low premium is an important factor, I would suggest you also get comfortable with the brand as well, that is the life insurance company. And that's because these term insurance contracts run into many decades, which means you want to be associated with a stable, reputed and long-lasting insurance provider. In other words, to get the maximum peace of mind per rupee, look at a combination of premium and the market standing of the insurance company. The fourth step requires us to choose some add-on benefits to our term insurance policy, or riders as they are commonly called. You see, term insurance provides basic life coverage. But then there are other events like a critical illness or an accidental disability which may not lead to death but can still threaten the financial stability of the policyholder and his or her family. Now, life insurance companies offer a limited set of riders which come at an extra cost, and there are four major ones here. The first is additional coverage for accidental death, wherein if the policyholder were to die in an accident, then an amount in addition to the basic death cover is paid. The second popular rider is a critical illness cover, where a lump sum amount is paid on the diagnosis of a listed critical illness. Rider 3 is a waiver of premium on disability, where future premiums are waived off if the policyholder is rendered permanently disabled. And the fourth rider is a waiver of premium upon critical illness, where future premiums are waived off on the diagnosis of a listed critical illness. Now, a very important point. Always read the fine print on all of these add-ons before enrolling for one. And I say this because rider terms and conditions can massively vary from one insurance company to the other. For example, 2 of the 4 riders have a listed critical illness element in them. Now notice I didn't say critical illness, I said listed critical illness, because some insurers have listed barely 8 illnesses in their policy wordings, while some other insurers have gone as high as 60 critical illnesses. Of course, what these 60 critical illnesses are and how significant they are is another matter, which is why it is important for everyone to carefully examine every rider when choosing a term insurance policy. The fifth consideration, and something which attracts a lot of searches on Google, is the insurance company's claim settlement ratio. Simply said, the claim settlement ratio indicates the efficiency at which insurance claims are settled by the insurer. So when you see a number of 98%, it means 98 out of every 100 claims reported to the insurance company was settled by it. Now again, a word of caution here. The claim settlement ratio is merely an indication, and if this number is over 97-98%, then it basically means the company is pretty efficient when it comes to claim settlement. My suggestion is one should avoid using this ratio like a statistic and start preferring a 98.6% CSR over an insurance company which is at 98.4%. In other words, it is advisable to use the claim settlement ratio more as a rejection filter rather than using it as a key decision-making criteria. And the sixth and final consideration when choosing a term insurance policy is the process and the documentation involved. Now, I have worked in a life insurance company. I've also distributed term insurance for many years at ET Money, and I can tell you there are big differences in the documentation each company requires, the turnaround time from application to issuance, and the process that each of these companies follows. For example, some companies are more amenable to giving policies to self-employed individuals and housewives, while other insurance companies aren't keen as much. Similarly, some insurers would insist on you going to a nearby medical center, while other insurers will arrange for a home visit, making it a lot convenient to the customer. And sometimes even things happen which are outside their control. Like in the months of January, February and March, when everyone wants to buy a life insurance policy just to save taxes, the application processing unit often gets choked and policies can take up to 3 weeks to get issued. Of course, this depends from insurer to insurer, but if you're using an agent or a financial advisor to help you out, then do inquire about these finer aspects. And speaking of finer aspects, here are a couple more points that you might find interesting and useful. The first revolves around the premium, and some life insurance companies offer a little discount, maybe 5%, when one purchases a term insurance plan through an online platform. When I use the word online, in most cases, it is not limited to just the insurer's website, but can also include aggregation platforms like Policy Bazaar, ET Money, PolicyX and others. In other words, always do a quick comparison of the premium across 2-3 different platforms before closing on the deal. A second point that came up during our research, and I found it rather interesting, is the benefit of purchasing a term insurance plan under the MWP Act of 1874. MWP stands for the Married Women's Property Act, and specific to life insurance, what it says is that if a man buys a policy under this act, then upon his demise within the policy period, the claim amount will only go to the wife, children, or named dependents in the policy, which means no creditor of an outstanding loan can stake a claim on those proceeds. This restriction also applies to any government agency and even family members that may want to get their hands on that money based on succession laws. Even those guys can't touch it. And all one needs to do is to sign an additional addendum when purchasing a term insurance plan, and the claim amount will directly reach your wife before it goes to anyone else. So these were some additional benefits, and whether it is applicable to you or not, having a term insurance plan in today's day and age is extremely important, and I hope you use parts of this presentation in making the right decisions when choosing one. Once again, thank you for your time. Do like this video, do share it with others who need it, and if you have any questions on buying the right term insurance plan, feel free to write back. Until then.